Have you ever wondered why so many smart people just seem to lose money in the stock market? Well, today we're cracking open the secrets of Benjamin Graham's The Intelligent Investor, and we're going to get into some timeless and frankly game-changing advice on how to build wealth by, get this, focusing on not losing.
So yeah, let's start right there with that big puzzle. Why do so many smart, hardworking people still lose their shirts in stocks? As we're about to find out, Graham had this wild idea that your intelligence, your effort, if you don't channel it the right way, could actually become your biggest enemy.
And this really gets to the heart of what Graham was all about. He saw that it's not about being some kind of financial wizard, it's about having the right temperament, emotional control, discipline. He argued that that stuff is way more important for success than knowing every formula in the textbook.
Okay, so how do you get that discipline? Graham's answer was something he called the negative approach. Forget about trying to hit home runs or pick the next big thing. The real secret to winning, he said, is to play rock-solid defense and just avoid the big, costly mistakes that can wipe you out of the game completely.
And the very first step in playing that defense is knowing what game you're even in. Graham draws this super clear line between investing and speculating. See, investing is all about careful analysis, protecting your money, and aiming for a decent return. Speculating? That's just about hoping for a quick buck, usually based on some hot tip without any real research. And here's the kicker. The difference isn't how long you own a stock, it's about the homework you do before you even click buy.
All right, now let's pull back the curtain on the traps that lure people into speculating instead of investing. We're going to dismantle the 3 biggest, most dangerous myths that Wall Street and all the market hype used to suck you in and, well, take your money.
First up, we've got myth number 1, the hot tip. Oh, you know this one. It's that seductive idea that you can get rich overnight by just jumping on the stock that everyone's buzzing about, the one that's supposed to be the next big thing.
To see just how dangerous this is, look no further than the Monument Internet Fund back in the dot-com bubble. In just the first 5 months of 1999, it shot up an insane 117%. It was the ultimate hot tip. The manager was all over TV promising it would make 50% a year for the next 5 years. The hype was just deafening. But here's the brutal reality of chasing that heat. By the end of 2002, once the bubble had burst, that same $10,000 investment was worth just $2,000, an 80% loss. A classic story of speculation, the meteoric rise followed by a catastrophic crash.
Let's move on to myth number 2, the crystal ball. This is the belief that you, or maybe some guru you're following, can actually time the market, predict exactly when to jump in before it soars and get out right before it tanks. Graham was super blunt about this one. After 50 years on Wall Street, he said he never ever met anyone who could do it consistently. And now for the last and maybe the trickiest myth of all, the sure thing growth stock. This is the idea that if you just buy a company in a booming industry, you're pretty much guaranteed to make money. I mean, the logic seems solid, right? But it's a really dangerous trap.
The US airline industry is the perfect example. For decades, passenger numbers just went through the roof. The growth was obvious to everybody. And yet, by 1970, the entire industry was losing money for its investors. So what happened? Well, brutal competition, insane costs, and paper-thin profit margins just ate up all those gains. The lesson here is so important. A great industry does not automatically make a great investment.
This growth at any price idea often comes with that dangerous phrase, "This time is different." Just check out this infamous quote from James Cramer right at the peak of the dot-com bubble. He was basically saying that Graham's old-school rules about value, they just didn't apply anymore in the new age of the internet.
So, what happened if you followed that new world advice? Well, a $10,000 portfolio invested in his top picks back then would have been worth just $597 by the end of 2002. That's a staggering 94% loss. Turns out, those old rules mattered. A lot.
So, if chasing hot tips, trying to time the market, and betting on growth are all recipes for disaster, what's the right way to do it? This is where we get to Graham's golden rule, a simple but incredibly powerful 3-part test to figure out if you're actually making a smart investment.
Okay, here's the definition, word for word, and it's so important. An investment has to have all 3 of these things. Number 1, thorough analysis of the business. Number 2, a promise of safety for your original capital. And number 3, an adequate or, a reasonable return. If even one of those is missing, Graham says you are by definition speculating, period.
Now, the really cool part is how you get that safety of principle.
And this leads us to what is probably the single most important concept in Graham's entire philosophy, the margin of safety.
This diagram breaks it down perfectly. So let's say a company is actually worth $30 a share. A speculator might buy it there or even higher up in that red zone, just hoping it goes up. But the intelligent investor, they wait. They wait for pessimism or some temporary bad news to push that price way down into the green undervalued zone, say to $20. That $10 gap, that's your margin of safety. It's your buffer against mistakes and just plain bad luck. But here's the real magic. It's also a psychological buffer. Knowing you got a discount gives you the guts to stay calm when everyone else is panicking. It's the art of buying $1 for 50 cents.
So where on earth do you find these bargains? Well, Graham's whole strategy was to look where nobody else was looking. He hunted for big, solid companies that were just unpopular. Companies facing temporary problems like a bad quarter or an industry downturn. He knew the market loves to overreact, pricing good companies as if their short-term problems are going to last forever. But here's the thing, even if you know all these rules, you know you need a margin of safety, you know to avoid speculating, there's still one final opponent you have to beat. And as Graham always warned, it isn't the market and it isn't Wall Street, it's you.
The story of long-term capital management is the ultimate warning. I mean, this hedge fund was run by actual geniuses, PhDs, 2 Nobel Prize winners. They built these insanely complex models they thought were bulletproof, but they used a ton of borrowed money and had absolutely no margin of safety. When a crisis hit that they didn't predict, they lost over $2 billion in a few weeks and almost crashed the entire global financial system. It's the perfect proof. Being smart is no replacement for humility and emotional discipline.
And this is exactly why that discipline is so hard. It feels like our own emotions are wired to betray us. We get swept up in the excitement, feeling that euphoria, and wanting to buy when prices are at their absolute peak, which is the point of maximum risk. And then when everything crashes, we feel that panic, that despair, and we get this overwhelming urge to just sell it all at the very bottom, locking in our losses right at the point of maximum opportunity. A successful investor has to literally train themselves to do the exact opposite of what feels natural.
So let's wrap this all up with something practical you can use right now. Here's a powerful checklist, straight from Graham's playbook. Before you ever buy anything, just run it through these questions. Do I really, truly understand this business? Is there a clear margin of safety baked into the price? Am I buying because it's falling and getting cheap, or am I chasing it because it's rising and popular? Think bigger. Would I buy the whole company at this price? How good of a deal is this compared to other things I could buy? And this one's huge. Am I using any borrowed money? Because if the answer is yes, it's pure speculation. And finally, can I explain why I'm buying this in one simple paragraph? This isn't just a list, it's your defense against bad decisions and all the market noise. The real question is, do you have the discipline to actually use it?